Sunday morning, a live look from our camera in New Haven. Matt Scott coming up with a forecast in just a few minutes. But as we start '09, it is the beginning of a new year, and the beginning of a year is always a good time to reassess things. And when it comes to your investments after the year that was, that is certainly a good idea. This morning, we've got 10 tips from Paul Schatz, the president of Heritage Capital in Woodbridge. Welcome back. Nice to see you.
Thanks for having me.
This is something that I think a lot of people are doing this year. They're hoping that with the new year, we can have a new start. And to take a look at your investments and where you are and where you're going is probably a great place. We have 10 tips. I want to get to them, get to all of them this morning. And the first one is probably a great place to start. Take a financial inventory. How do you do that?
This one's easiest. Statements are going to start rolling in a week or 2 weeks. Very simply, if you have a spreadsheet at home on Excel, or if you get a piece of paper and a pencil,
Yep.
it's going to be write down all of your assets, all of your accounts, put their value as of December 31st, '08, and the value as of December 31st, '07. You can do a quick snapshot of where you are and at least begin a plan there.
You do that, then you can do tip number 2, which is to rebalance your portfolio.
In the simplest terms, if you have a 50-50 mix of stocks and bonds, well, stocks went down a lot more than bonds did in 2008. So your allocation is a little bit out of whack. You're going to want to bring that back to whatever mix you began at the beginning of the year, whether it's 50-50 or 60-40, depending on your risk tolerance.
The next one's a tricky one. Stop chasing the winners, because your instinct may say you want to do that.
Early in the year, people look back in the rearview mirror and say, hey, what did best in '08?
Yeah.
Let me invest in that in '09. It doesn't work on balance. It never has worked. So the idea is not to look at the magazines and say, geez, government bonds were great in '08. Let's buy them in '09. Doesn't work.
Doesn't work. And that's why you need to be, as tip 4 says, proactive.
Absolutely. In '08, at the beginning of the year, markets really began to unravel. And I heard so many people saying, I'm just going to sit tight and hope it comes back. Well, hope is not an investment strategy, and it's never going to be one.
Right. Yeah. You know, you talked about this a little bit earlier, but you say you need to diversify beyond just bonds and stocks.
Yeah, there are other things that people can invest in now. Every year, different kinds of products come out. There are currencies. It's real estate. There are commodities. There are other blends you can have just besides stocks and bonds. Stocks and bonds typically move in the same direction, where currencies and commodities and real estate don't.
And again, that has to do with making different strategies for your portfolio as well. The next tip.
Absolutely. People think, let me just buy some good stocks and just hold on for the long term. We'll probably do fine. I challenge you, go back 20 years, 30 years. What was considered good back then is clearly, as you saw in GM and Ford, not good today.
And the next tip is something that we've talked about before, and it can be very difficult, but you can't forget about your retirement investments.
Absolutely. If you're a 401k investor, in the fourth quarter of '08, most people were cutting back what they put in because the market had gone down. That's the exact opposite. When the market goes down for your 401k, you want to up your allocation. If we had a big run this year, let's say the market up 30%, then you say, let me take some off the table. But people are doing the opposite. You need to increase your retirement contributions now. We have a 50% off sale in the market. So let's do it now rather than when it's up 50%.
Right, exactly. This is the time. All right, focusing on municipal bonds on the state level. That's a specific thing. What do you mean by that?
Yeah, a lot of people invest in municipal bonds because they want as little risk as possible, take some income to live on. With the economy being where it is, I think the state-level municipal bonds, the stuff from Connecticut and stuff from New York and the more stable states, will do better than the stuff in the local level. There will be municipalities around the country that don't pay their bonds.
This one, another tricky one, ignoring the guru forecasts, because you're always kind of listening to this stuff, and you want to know, well, can I follow him or him or him or her? Or, what do you know what to follow?
Exactly. If you hear something or you see something or someone tells you something, that's fine in the background. But the problem is that forecast made in January, that person's likely going to change their forecast in February, March, April, or May. You're not going to know about it. You're not going to be able to ask questions. Unless you have access to the expert you're dealing with, ignore the forecast.
Right. But the last tip is seek help. Find someone that you trust, that you know you can go to, and that you can go to consistently instead of just hearing that one forecast.
Absolutely. If you go through all this and geez, I'm really lost, or you're kind of like a deer in the headlights, I'll do nothing. No. If you can't do it by yourself, there's nothing wrong with picking the phone, going online, and finding a professional to help you out.
Yeah. Paul Schatz, thanks so much from Heritage Capital in Woodbridge. If you missed those tips, we ran through 10 tips very quickly. You can find them again on our website at WTNH.